Welcome to TS Lombard. I'm going to talk you through our outlook for 2018, which in many ways is on consensus, but in important ways is not. When it comes to the consensus bit, we agree with the majority of people who think that growth is fine and that the stock markets are going to do okay as well. So in that sense, we're conventionally bullish. But where we differ is that we think this is not just a cyclical change, this is a longer-term shift into a healthier economy in terms of world balance than we've had all this century. And one reason, of course, is that we have now three major locomotives: the United States, China, and North Central Europe gathered around Germany. But the other reason is that the growth rate does not, to a great degree, depend on debt anymore, unlike the situation before the crisis. And also the savings glut, which was one of the reasons why debt had to rise so much in the deficit countries, the savings glut is now diminishing quite rapidly, and we think will diminish further. So those are the causes of medium-term optimism. Now, the downside, of course, in all of this is that if the economies are reasonably well based, then we shouldn't really be engaged in monetary stimulus. Whereas in fact, the Fed is engaged in monetary stimulus. The real interest rate for Fed funds is about the same as the rate of inflation, if not slightly less still, even after the recent hike. And that is a stimulative policy in a country where the average Fed funds rate over the last 50 or 60 years has been 2% ahead of inflation. And of course we know that there is ultra-stimulus in Europe and ultra-stimulus in Japan. So what we have is three central banks pursuing 2% inflation in a world in which it really does look as if the natural rate of inflation is approximately zero. And to get to 2% inflation, therefore, they require excessive stimulus that will lead to overheating. And of course that means that the inflation rate, if it does reach 2%, will go sailing straight through. But more importantly, in the meantime, the likelihood is that this kind of environment of good growth and excessive stimulus is liable to create a stock market bubble, a hint of which we've already seen in the behavior of Bitcoin. And a stock market bubble, of course, will be followed by a bust. So that the danger that we have in the current situation is that eventually these central banks are going to have to tighten viciously again, too much, too late, and we're back to stop-go, or rather, in this case, go-stop. So 2018 is the year of go, and we feel good about that, but there are threats on the horizon in 2019 and 2020 that are being pushed ahead and worsened even as the economy does well.